Good afternoon and welcome to our webinar. This is Centennial Advisors. I'm Justin White, Managing Partner, and I'm joined today, as usual, by Jason Brooks of Buckhalter. Jason and I periodically get together to talk about some of the things facing real estate investors, not only with California assets, but also across the country. Jason, pleasure to be joined by you again today. This should be a fun one.
Thanks for having me.
Today, we're going to talk about really interest rates is kind of the thing on everybody's mind and the big impact. But if there's one goal that we want to get through or get from this webinar today, it's really, what am I looking at? Having each of our clients or everybody kind of take stock of exactly where they're at. We've been on a good run for a while. Interest rates have been low. People have made a lot of money with their property and rents have gone up. But really, where am I at today? What has changed since the last time things weren't, let's call it, close to perfect in the real estate world? And does what I have today line up exactly with where I want to be for the next 10 years? And what do I want from the 10 years after that? We're going to talk about interest rates. We're going to talk about some strategies that people can use to minimize the impact or even take advantage of the opportunities that will present themselves as we see rates rise and rates continue to rise. But that's kind of the goal for today. As always, our rules of engagement. If you've got a question, type it in the chat. We'll get to it over the course of the hour. We'll try to keep it exactly to an hour. Jason and I are going to go through some slides. We're also going to talk about some deal stories and things that we're seeing on a kind of on what's crossing our desks right now. And we'll get started. Jason, you got any early comments you want to make regarding the topic today or what we're going to cover?
No, I think there's a lot of concern about rising interest rates right now. And as you and I were talking about before this, there's always opportunity created in every situation. So I think hopefully we'll be able to show people why there is an opportunity right now in a situation that some people might think is less than positive.
Yeah, and I think that's really what we're hoping the takeaway to be is that there are options and there are opportunities in light of things changing and interest rates going up. Whether it's somebody who's got a long-term positive growth outlook about their real estate portfolio, or somebody who's maybe nearing the end or they want to change, we're going to walk through what the different opportunities are for each group, as well as suggest really some very specific opportunities that you can take advantage of, or that we're seeing other clients take advantage of. But probably the best place to start, or the first place to start, is going to be kind of where are we at, what's going on, why we think it's a worthwhile topic. And that's going to take us to our first slide, which is really, if nobody follows it, the Federal Reserve chairs meet on a quarterly basis. And what each one of the 14 Fed chairs does is predict where they think the federal funds rate will be, the overnight rate, at the end of 22, the end of 23, the end of 24, and then in the longer run. And it's just kind of a good prediction of where interest rates are headed. And what we've got for you here is the December 21 projection. So just a little over 3 months ago, what the outlook was for the remainder of 21, early into 22, and then 23 and 24. And if I can figure out how to do this, I get it. There we go. So you can see here, and we have boxed kind of where the median is. But the outlook was for rates not to really go up very much throughout 2022, back in December. But our next slide, and kind of how quickly things move, tells a different story of what we think and what we've been reading in the papers lately. You can see that it went from just under 1% at the end of 22 to just under 2% at the end of 22 in the latest Fed chair projection, and then slightly higher and making a little bit of a move closer to 2.5% by the end of 23, which really kind of falls in line with what we've heard recently from the Federal Reserve that we may see, and then those that follow the Federal Reserve, that it looks like we may see 6 quarter-point increases in 2022, followed by 4 more quarter-point increases, which the federal funds rate, not necessarily the rate that dictates where we see lending on any product type that our clients own, but certainly a good indicator of where rates are going and what the outlook is. Jason, any comments to kind of what we've seen and heard over the last couple of months as it relates to rates?
I mean, one of the things too, Justin, that often gets pointed out recently is the high inflation numbers, the monthly inflation numbers, which I'm sure we'll talk about as it comes to AB 1482 later on today. But the easiest way most people say to combat inflation is through the rise of interest rates. So if the government chooses to, try to lower that inflation number, they're going to have to raise the rate. So I think that this is probably a pretty accurate assessment of where we're going.
Which will lead us kind of to our next prep slide or preparing for the later discussion is what does that really mean for building owners? And so what we've got here is an example of just let's call it a typical building that was worth 6.2 million as of a month or two ago when rates were significantly lower. In this case, if it's an apartment building, it's a 20 unit apartment, 15 to 20 unit apartment building, depending on location. Also really probably a 15 to 20,000 square foot industrial building as an example. And what we've got here is just kind of shows that as rates go up, how that impacts the price. And where it really impacts the price is in the required amount down for an investor, but then also the additional cost of borrowing, which reduces cash flows. So we can see that if we were borrowing at a rate of 3%, which we were seeing a little bit ago, taking it out to the 4.5, if we assume that rates go up 150 basis points for the rates related to investment real estate, brings our value down to 5.4 million, an almost $800,000 decrease in value for the same income stream. But if we take that out and there's no ability to increase rents into 2023, if we saw the additional potentially 100 basis point increase, now that property that was worth 6.2 million for that same income stream to produce the exact same cash flow is now down to $5 million. So interest rates can have a significant impact if we're not able to adjust the income stream. Jason, I don't know if what you're seeing in the negotiations and back and forth on purchase agreements that you're preparing, but already starting to see buyers adjust pricing, make some changes, not only for where rates are at today, but for where rates will be when they ultimately close a property in 60 or 90 days.
Right. Well, we're seeing a lot of, especially let's just say, for example, on a net lease property, where everything was going for right at the asking number, maybe slightly below, or maybe 5 to 10 basis points above. Now people are making offers. I mean, we made an offer today that was 60 basis points above the asking cap rate. But when you look at it from 60 basis points doesn't seem like a lot, but it's actually, 10, 12% higher than the initial cap rate. And so that's actually a big difference. Do I think we're going to get it? No. But do I think we'll settle somewhere in the middle? Yes. Also, people are prepared on those kind of transactions. For example, we were getting 50% down, 50% leverage, some deals at a higher cap rate, maybe 65% leverage. People are expecting to get less loan proceeds going forward. So they're just preparing for the amount that they're going to need down. So it is affecting, buyers on all fronts, which, as you know, Justin, ultimately affects the sellers as well.
Yeah, it's certainly something that we've all got to be mindful of. And there's certainly still great opportunities for both buyers and sellers, depending on where people are at. And one of the best ways that I think we can all mitigate that is when we talk about rent increases, regardless of your product type. This chart here shows you how much your rent needs to increase to offset an increase in interest rates. So you can see, for example, if interest rates go up 0.5 point for somebody who's got a variable rate loan that resets, adjusts, in order to get the same amount of cash flow, your rents are going to have to increase 3.3%. As we get into some of the bigger increases in rates, particularly 1.5%, let's say, now we're at 10.2% increase in rents in order to provide an investor with the same cash flow that they had prior to that rate adjustment. Speaking of rate adjustments, Jason, what are your clients seeing on rate adjustments, let's call it, over the last 30, 60, 90 days?
So the rates have gone up, and it's gone up pretty substantially. So we were talking earlier about, let's just say, a Fannie Mae or Freddie Mac loan on an apartment building. About a year ago, we were doing Fannie Mae refinances where you could get it down as low as the mid twos if you did some green program items and others. Now you're lucky to be in the high threes. You're likely in the low fours. So then Fannie Mae has become less competitive on apartment buildings. So people are looking more to, banks or to credit unions, local sources. We just rate locked a loan for a client yesterday on an apartment building, or a couple of days ago on an apartment building, at 3.75%. But that was one where you and I were talking, where it was based on the 7-year treasury on the day of the rate lock. And the day before the rate lock, the treasury was at 2.3. The day we locked was 1.95, and then the day after was 2.2%. Right. So just by picking the right day, the client saved themselves anywhere between 35 and 50 basis points on the rate, which on a $33 million loan is a substantial savings over the life of it's a 7-year fixed term and then a floating rate after that.
Just a second. Yeah, that's a significant amount of money that they're saving on a monthly basis for that.
I would say, Justin, the only place where things are unchanged right now is some industrial, especially with a really strong tenant. Like you can still get great rates if you have a warehouse with Amazon in it or FedEx. But besides that, everything has gone up at probably at least 100 basis points.
We certainly have seen a lot of movement in a short period of time, which kind of leads us to the next slide. We'll show you goes nicely with what we were really talking about to start today, and that it's not just about interest rates and what you can do to offset some of the impacts. But since the last time we saw rates increase significantly, or since the last time, the outlook for investment real estate may not have been as robust as it has been in the last few years, was before a number of different things happened, especially, and I'm going to show a slide that is really, I would say, relevant to the multifamily owner. Years ago, when there was no real rent control in California, aside from LA and West Hollywood, Santa Monica, a couple places like that, owners really had the flexibility to adjust rents as needed or as it was available to maintain their incomes. But the next one we'll show you is that in light of all the recent legislation that has enacted rent control, what exactly that looks like today. So what you've got on the screen now is that exact same graph that we showed you last time. But in blue, we've got 4 different, let's call it rent control examples. On the far left, you have LA City and LA County, which have a rent freeze until at least 2023. In particular, LA City's is 12 months after the end of the state of emergency is when landlords can increase rents again. So we're not going to see, unless there's a vacancy, an owner's ability to increase rent to offset any sort of interest rate increase that they might be experiencing. The next one that you have there is Santa Ana, which, for those of you in Orange County and some other areas that thought, places like Orange County will never see rent control, Santa Ana enacted rent control late last year. They have a 3% max annual increase on existing tenants, which, if there's a half point increase in somebody's rates, the max Santa Ana increase will not keep pace with the additional cost to borrow. Then an LA neighborhood, Baldwin Park, has their own. They've got a 5% max annual increase. And then the far right blue line shows you, should we get what we expect from the 2022 AB 1482 maximum allowable increase of 10%, it just about offsets a 1.5% increase in rates. So that's what you've got on the blue lines. But what we want to show you next is on those green vertical lines is what's been projected from the Federal Reserve. We took that off the dot plot, that rates increasing in 2022 will outpace even the best allowable rent increases in California. And then if we get to 2023, you almost have to have 2 years where the allowable increase from 1482 would get you to be at just the equal number of offsetting increased loan payments. So it's certainly a different environment. For those of us that have been in the business a long time and dealt with a lot of multifamily product, the flexibility to increase rent as you need it, and control your occupancy and who was there and what they were paying has certainly changed. And now with increasing interest rates, it's really probably a great time to look at, is the property doing for me what I need it to do and what I want it to do? And just the sitting back and kind of waiting and seeing what happened may not be the most profitable strategy. Jason, maybe that's something to talk about. Over the last 60 or 90 days, who are you seeing taking the most action in response to some of the interest rate changes, and what are they doing? And then some of the legislative changes.
Right. So, and that's a great question, Justin. It's really fascinating because the first blue line that you posted, right, says when the rent freeze goes towards an LA County. Well, there's no guarantee that LA doesn't extend that either, right? There's no guarantee that that doesn't get pushed, which would set you further back. What we're seeing right now, and by the way, a quick side note on Santa Ana rent control, they don't really know what they're doing. They implemented a law and they don't have a lot of plans. So if you own in Santa Ana and you're hearing different things, that's okay. They're kind of operating on the fly. We're happy to help you and talk about that. Your advisors also, at Centennial are getting constant updates from my team on where things stand. So feel free to make a call about that. Because I had a Santa Ana owner, Justin, call me the other day. I was like, I'll just, I'll get the tenant out. I'll bump the rents up to market because I'm behind. And then they found out it was, 90 days notice, 3 months rent, right? And all of a sudden it starts to get cost prohibitive. It starts to get really expensive to get someone out. Are you going to be able to bump rents enough to make it worthwhile? So those are things to keep in mind. But who we're seeing really active on the buying side are clients that already have large portfolios and potentially in-house management companies, people that, and the cap rates are still not far off from what they were a year ago on let's just say the apartment buildings, for example, because the buyers that are coming in are experienced. They either have their own management team or they have a system and plan to increase rents, increase their NOI. They are comfortable operating in a rent controlled or rent restricted environment. And oftentimes when they have portfolios of that scale and nature, they're able to get relationship based loans at banks. And so their loans are going to be at a little bit better than what other people can get at market. A lot of the sellers we are starting to see even more are people that are seeing the writing on the wall. They're seeing, and I know we'll talk about this later, but the potential elimination of Prop 13 and split roll becoming an issue on taxes, people that just don't want to deal with tenants anymore, people that don't want to deal with rent restrictions, people that realize that things aren't going to change for the betterment of landlords over time. There will just be more rules and restrictions that make it more difficult. And they've decided either I'd like to find some sort of multifamily property because people think multifamily has a lot more upside out of state, or some sort of net lease deal or an industrial property. But one indicator, Justin, of how great the multifamily market is outside of California too, if one of our clients, on this call wants to exchange into something out of state, someone that you and I are actually working with bought a property in one of your favorite places, Colorado Springs, beginning of last year or maybe end of 2020 for about 17 million, and they are in contract for $28 million today. So, and not much has substantially changed. It's just people are leaving certain markets. Cap rates are then being compressed in the newer markets. So I think now is an opportunity, while rates are still competitive and buyers are still being aggressive. If you want to reposition your portfolio, today is the day to really sit down with an advisor and analyze where you want to be for the next 10 years. It's not hey, I'm okay for the next 2 to 3 years. I think you need to really sit down and have a conscious discussion about what does my portfolio need to look like over the next 10 years for me to feel good about my real estate investments.
Great, Jason. Maybe to follow up on that question, in addition to the transactions that you're seeing, what about just from a, let's call it strategic standpoint, looking at options, really evaluating where they're at as it relates to debt in place, debt that they can get, product types that they have versus product types that they might consider? Are you seeing any themes or any commonality to the people that are proactively doing stuff right now?
Well, I think people are still trying to, if they can, and it's a rush to lock in long-term fixed rate financing under the guise or theory that 3.5, 3.75, 4% is much better than 6 or 7%. You put up slides earlier that showed how the rates are going to continue to increase over the next few years. And so I think people see, if they like the assets they're in, I need to fix my financing before I face continual increases over the next few years. And then those increases affect my ability to borrow. I mean, a 200 basis point move in increase from today. So if rates go up 2% total, you're looking at potentially people that bought properties in the last few years at low cap rates having to do cash in refinances. I know that's something that people have maybe even never heard about, but where you actually, in order to refi out of your current loan, you have to put in additional equity in order to meet the lender requirements. And that's never a fun thing to have to do. So I think people are trying to get fixed, knowing that we might have high rates for the next 3, 4, 5 years. So being fixed for 7 to 10 is going to be really helpful.
Great comments there, Jason. One of the things that I've seen recently and you have liked, and I think it's something that when somebody's got 5 or 6 or 10 investment loans, they look at it a little differently than maybe somebody that doesn't have quite as many. But in the last couple of weeks, we've been sitting down with people that have a fixed rate loan still for a period of time, and they've got to prepay, let's call it 3 to 1%, something like that. And we've been helping them look at it and go, okay, this is what the prepay is. But if you did it today and you locked in debt for the future period versus waiting till when you don't have to pay that prepay, are you a net winner or not? And it totally depends for each person and the loan amount and where their rate's at, what it's tied to. But taking that proactive approach, not to look at the prepay penalty as just a sunk cost, but can you actually come out ahead by paying your prepayment penalty, is something that I'm seeing more and more investors take a look at as they kind of see the writing on the wall. And, you said we could be in this for 4 or 5 years. If they have that sort of outlook, locking in 4.25 today is way better than, eating 6, 2, 3 years from now.
Well, and Justin, you brought up 2 really good points there. One on the prepay. We're also seeing people look at it and say, if my business plan was to sell 3 years from now, but if I can get 20% more now than I would 3 years from now, or even 10% more now, is it worth eating a 1 or 2% prepay to sell my building for substantially more? So people are actually looking at doing that. People are saying, you know what, I will pay my prepay to get this higher price because net I'm far ahead at the end of the day. The other item that we're seeing too, besides, the prepay, is if you were a buyer that went into a market and you wanted to be in it for, let's say, 4 or 5 years, and you went in 2 years ago or a year ago, and you locked in a really good loan that has 10-year fixed financing, we're actually starting to see a lot of loan assumptions too, Justin, where buyers actually see a substantial value in having a really great loan on the property for the long term. So there are people are doing loan assumptions now, again, which we haven't seen in a handful of years, which I think is really interesting. And if you're a buyer or you're an owner that locked in great financing in the last 18 to 24 months, that actually could be a long-term benefit to the value of your property.
It's the exciting part about real estate. It's always changing.
Right.
And that loan assumptions are back as a positive was something we hadn't seen for a while. To Jason's point, if you just look at this graph, if you assume this light green one, the 6,068,000, I mean, even if you had let's call it a $3 million loan and 1% prepay, you pay off that prepay versus waiting till later when that when debt is higher in the market and you can only sell it for 5.3, but you don't pay the prepay, you're still a net winner and net ahead. And I think that's some of the conversations that people are having right now in being proactive about their portfolios. Is this, what I have right now, is it perfect for where I want to be down the road? Or is there something that can make me more money now, or better position me, or make things easier? And by doing something now, and maybe, losing a penny to make a nickel might not be such a bad idea.
And Justin, look at your graph. It's a perfect example of how having a good loan also helps, right? If you have a fixed loan at 3.25 and your building's worth 6 now, someone can assume that for 7 years, or they can put a new loan in place at 5. That loan is actually worth $900,000 in value to you as a seller and to the buyer. So it works collectively across the board for everybody.
All right, we'll walk you through one more thing before we give you some strategies. We're going to show you a series of graphs here. What these are the average cap rate, in this case, Orange County industrial, over the last 33 years, and the spread between the average cap rate and the 10-year treasury. Now, what this is, why we show it, is because it is a great indicator of direction of the real estate market and when there are great opportunities. So looking at it, and I'll start with the reds just because it gives us the easiest time to remember for some of us. But you've got in 1990 and 1991, the cap rate for an industrial building in Orange County was lower than the 10-year treasury. Usually a bad sign for real estate. In the early 90s were not a good time for any type of investment real estate. Take your flash forward to the middle of the graph, 2005, 6, and 7, when the cap rates dipped below the 10-year treasury. And what did we see in, certainly 8 and 9, and maybe even a little bit of 10 as it related to values and a real estate recession. Currently, the spread between industrial in Orange County and the 10-year treasury is 1.58, which is about 130 basis points below the 30-year average between the two. We show this and we'll go through each of the products, then kind of make some comments. That the reason I wanted to show it is that there are different product types that might be better positioned or better value relative to others. And for, if you have a industrial property that you may not have the use for anymore, certainly now with the prices you can get, the enthusiasm for industrial, it might make sense to look at what your options are, especially if you've owned a property for 30 or 40 years and split roll might be coming. It could be totally a game changer. But this was industrial. These are shown in order of how far they are from the 30-year average. So every one of these product types is actually below the 30-year average, which would say that from a relative risk standpoint, industrial in Orange County is overvalued relative to the return you could get from and security that you could get from the 10-year treasury. And of these 6 products, it would say that it is the most overvalued or most likely to see some sort of pricing change, especially in an interest rate increasing environment. And I know I say that's purely based on the cap rate in the 10-year treasury. It might not look at the supply chain, the demand for industrial coming out of COVID, certainly a lot of other factors. But historically, this has been a great indicator of when might be a great time to take some chips off the table. So that we've got industrial in Orange County, industrial in LA County. Same story, not surprising. There's been some great years, which would have been the greens, who would have loved to buy industrial property in 2013 and 14, would have made a killing on it. I think that we looked at some numbers, and the cost per square foot in some areas was 120 or 130 bucks in 2012, 13, and 14. And now for non-cannabis related industrial in LA County, it's 270, 280, 330 for the same product. Next one, Orange County retail. again, even with what we're seeing in with COVID and what happened with retail, cap rates still showing below the historical averages. We get our first apartment product, you know, and on this one in the early 90s, obviously apartments got hit hard, tax changes, all the syndications that had been occurring there, and changes in passive losses hit the apartment market in LA County really hard all throughout the 90s. But you can see, again, 12 and 13, lots of people on this call bought deals, have done really well. What's interesting, and I'll talk about it here on this slide, is that you can see in LA County in apartments from about 12 and 13 to 18 and 19, it was gradually cap rates were compressing and compressing and compressing. And we were getting close to the point where the cap rate was going to be at about what the 10-year treasury was, which was really bad typically for the values of buildings. And there's usually a real estate recession when those things happen. But COVID happened and interest rates dropped dramatically, and it immediately created one of the best buying times, which would have been the spring and fall, or the spring, summer, and fall of 2020. And as interest rates have increased significantly, over 100 basis points on the 10-year since January of 2021, and cap rates have compressed, especially in apartments in LA because we've had such little rent growth. The relative risk has adjusted accordingly. Orange County apartments, same thing. Currently, the spread 1.73. The historical spread's been about 2. Of the products that we see in Southern California, maybe one of the safest choices right now. Jason, you want to make any comments with all of your multifamily investors that you're working with? From our end, we're seeing a great deal of interest in moving equity from LA County into Orange County on the multifamily side and into the Inland Empire. Any comments on that with some of the larger investors you work with?
I think a lot of people are just trying to move capital outside of LA County unless you have a huge established practice there where you're just used to operating in that environment because of it's mostly governmental issues. You can put Santa Ana to the side a little bit, but and it's interesting. We have LA County investors that are used to rent control all now coming into Santa Ana because they know how to operate in a rent control environment when normal people don't, or normal investors in Orange County don't. But a lot of money's going into Orange County and Riverside counties and even San Bernardino County because during COVID things were more open. There's a lot of people moving there. There's population growth. There's rent growth. Businesses feel more comfortable operating in that space, and it's an easier place as of now to operate as an owner. Ultimately, things might change, but for now, they're substantially easier than operating in LA.
And then the last one, and maybe relatively the best value in Southern California right now, LA County retail. Still with that spread between the 10-year treasury and cap rates over the last 33 years, still below the 33-year average, which was 2.96 at 2.78. But just wanted to kind of show you some of these things. It kind of, again, dovetails with what Jason encouraged at the start of this call. Where we're at now, where you want to be looking at all the different factors about where the market's at, and more importantly, what impacts your investment and the performance of your investment, layering where you want to be, what your goals are on that. Where am I at right now? Where am I really at? What's going on? Where do I want to go? And what could affect me that maybe I hadn't thought about before, which kind of takes us to, as rates increase, there's really kind of 2 paths. Real estate's been a great hedge against inflation in the past, and people will grow their portfolio and have the ability to grow their rents when given the opportunity. And I think we'll see some people acquire assets. The other path is maybe for the more price or cash flow sensitive investor or doesn't want to be in their current property or the real estate game for that matter for the next 10 years. What are your options? And we're going to talk about some of the things that we're seeing people do in the market, and maybe some really good strategies of what you can do. I think the big one, or the easiest one, when you have increasing interest rates, getting yourself into assets with NOI flexibility. Jason, what have you seen in equity movement from, let's say, office or retail or large industrial with long-term leases into the more hotels, self-storage, shorter-term lease sort of product? Are you seeing equity move into those things because people like the flexibility that they can move their income stream?
So I think there's two reasons why the capital is moving there. One is, to your point, the full flexibility, whether it's the ability to increase rates regularly, which is your NOI flexibility. A little less on self-storage for my second comment than hotels, but the cap rates are still really strong on hotels, where from a return perspective, because coming out of the pandemic, there's still some concern. What happens if the world shuts down again? I think that there's still some opportunity there. I think we have gotten to a point where the world's learning to live with COVID. It's not something that it's just going to disappear and go away anymore. It's now we're learning to live, operate, and survive with it as part of our lives, just like the flu. But yeah, short-term leases, and I mean, I've even seen people, Justin, that are looking at taking well-located apartment buildings in certain areas. Let's say near Broadway in Nashville, for example, and it's a 10, 12 unit building, and they trick them out really nice and just Airbnb them, right? Or, people are buying, nice like vacation homes as an investment, though, and Airbnb them because the returns are getting look, at the end of the day, you only have to be rented out 2 weeks a month and you more than cover your debt service. People pay for cleaning, which covers a lot of the maintenance costs. So those are great opportunities to look for that flexibility, which will allow you to continue to grow. And, somebody won't pay, $7,000 a month rent for a house, but they'll pay $5,000 for the week because it's a vacation. It's a special spend, something like that too. So those kind of things, hospitality is really actually doing well. And then self-storage, just because people are constantly moving, especially in areas where people are moving too. I think it's important to point out, I think last year for the first time in 20 years, the LA area, the San Francisco area, and California as a whole had a population decrease. So
yeah, net migration out of those areas for the first time in a long time. We'll go to the next one. I'll work my way down the left side here. Little or no rent control restrictions. We just talked about short-term leases on the self-storage side, but I think that's why we're seeing cap rates historically low in self-storage, is that you basically get an apartment unit without any people and without any rent control. Jason, maybe make a couple other comments. I think that we've seen the money move from LA to Orange County in the Inland Empire, which is trying to move to little or no rent control restriction environment, and out of state. We'll get into more maybe the government stuff in a second and some options there. Areas growing economies, like you mentioned Nashville the other day. My question to you about Nashville is, do they have a bunch of Airbnb laws in Nashville that prohibit you from doing that like they do in some places here?
No, they don't. They don't have those Airbnb restrictions, and they don't have short-term rental restrictions. There's actually, California seems to be the main state with short-term rental restrictions. You might find them in certain places in CC&R documents. So like if it's in a community that's gated, there might be covenants on the property, but there's not a lot of places with short-term rental restrictions outside of California. California likes to have them, especially in beach cities and other places where people might want to go to vacation, which seems counterintuitive. And so even the rent restrictions, most states don't have rent growth restrictions. There's no rent control. You can raise rent. So if you find areas that are starting to really, grow and expand, or where a building where the rents happen to be far under market, you can go in and really bump rents, which creates a huge amount of value for you as an owner, whether it's holding it and just getting greater cash flow, or selling it and making a large delta to exchange it into something else.
Great. Next one we've got on there is government that supports business and growth. Jason, you guys are a national firm with probably thousands of attorneys, if not tens of thousands of attorneys that have offices everywhere and are involved in a lot of, let's call it, business and companies growth. But I'll make a quick comment that, we're seeing a number of investors targeting the Intermountain West because of not only high degree of college education, quality of life, and then because of college education and quality of life, businesses and technology businesses moving there, and those places super supportive of that business, super supportive of that growth, happy to take Californians that want to move into these areas. What are you guys seeing, or what comments might you make on some of the next areas that are super supportive of business and growth and might be wise investments?
So I will tell you, our two fastest growing offices, well, it was our Orange County office was the fastest growing, but now it's actually our Salt Lake City office and our Denver, Colorado office. We started Salt Lake with 6 people in November, and we're up to 24 attorneys already. Just because the movement in of business, the growth, our clients moving. I think it's important to look at where companies are growing and building facilities and opening headquarters, and especially some of the big companies, because as somebody reminded me the other day, when the big companies move in, there's a lot of other smaller companies and a lot of other smaller businesses that come in to support those big companies. So whether it's Amazon having 2 towers in Nashville, or Oracle building a $1.4 billion facility there, or in Arizona on the north side of Scottsdale, the largest chip manufacturer in the world is building a 1 million square foot plant. And then on the south side of Chandler, Arizona, which is South Phoenix, there's the second largest chip manufacturer is building their own 1 million square foot facility, right? So as those come in and they bring, I think the Oracle facility in Nashville is bringing in 30,000 employees. Well, that's, let's just say, family members, everything else, you're probably looking at 100,000 people, and then all the businesses around Oracle that will support them. And so I think you look at where those companies are going and growing, and that's the places that you want to try to find, assets that you can buy, because they're just going to go up in value, right? Whether it's rentals or retail, you're going to find a lot of tenants.
The next one we've got on our list on assets with NOI flexibility, or at least strategies on strategies to implement to take advantage of opportunity in the environment that we're in / continuing to head into, is really going to come down to management style. And Jason, I think you're going to have a lot of good comments on this in a second, but we've really there's almost kind of 2 schools. There's the really proactive manager that manages to constantly be growing their NOI. And then there's the management style of, I just want to have as few headaches as possible. And in my 20 years in the business, this might be where I've seen the biggest negative impact to one of these groups, in that 20 years ago, when I got into the business, you could basically do either one and pretty much turn out the same. Market was going to, work for you. Limited supply of product meant that rents went up, and you could sell a property with low rent. And as soon as there was the opportunity to increase the lease rate, the new buyer could do it to any level they wanted. But we don't see that anymore, especially on the multifamily side. And the comment that I would like to see you make, Jason, is just, are you seeing more and more of the few headaches as possible owners of property in your office or on calls with you, because they're more and more getting trapped or caught in the legislative environment that is making it harder for them to do well?
Yes. Our institutional owners are not changing. I think they're getting, because of the size and the scale of what they have in their portfolio. But our smaller owners, our mom and pop owners, are individuals that went out, 25 years ago and bought a 4-plex in East LA for $300,000, and it's now worth over $1 million, something like that. They don't want to deal with the headaches and the tenants, and they've gotten great rents over the last 20 years. They've gotten an incredible amount of property value and appreciation. We've got a lot of clients that are, they've been doing this for 25 or 30 years, and they've had these buildings for a long time, and they don't want to deal with the tenants anymore, and they're getting close to retirement. And I think it's also a lifestyle decision at some point, where you're getting to a certain point in life where you don't want to have that problem anymore. You're getting ready to retire. You just want to know that rent check is showing up, in a net lease situation, probably 4 days before it's due. You just know it's going to be there. You have a good tenant. You don't have anything to worry about. And also, a lot of it, Justin, at this point is starting to become estate planning thought process, where the family member was totally fine, or the parent, the owner, operating a building. The children, this isn't what they want to do. It's not what they do. And can we position them into an asset that is no headache for eventually down the road when they do inherit it as well? I think it's becoming a very common, let's just move on out of this California, concern with the legislature and the rules.
And then the last one we've got on there, great way to manage your NOI, increase your NOI, give yourself flexibility, is assets with additional income stream. And acquiring assets, or looking at your asset and identifying what your additional income streams that somebody will pay for, whether it's an industrial facility with 40 extra acres of timberland, or Jason's done a great job with a number of clients on the multifamily side of identifying what they rent and what is affected by rent control legislation and what is not, and how you can parcel that out or separate some of that so that you can continually increase rents. Or for some of our other leased investment owners, whether it's helium mining or using the roof or or monetizing off hours, there's lots of ways that an owner can look at their asset and identify what additional income streams might be there that they're not monetizing. Jason, any comments on that? I know you can make plenty of them as it relates to the multifamily segment of it, but any ideas or things that people might want to consider that they're not thinking about?
Well, multifamily, we've talked about a bunch, right? Whether it's washer dryer rentals, parking rentals, there's other things, putting in RUB systems so that you're not paying for utilities. But I'd say to focus on the commercial side of things. If you have a ton of extra parking, right? There's often times, and you happen to be within a certain distance of a car dealership. Right now, car inventory is super low, but when it picks back up to the normal amount of car inventory, they're always looking for, places to park cars, that because their lots don't hold them all. So, how can you utilize extra parking that you're not using at the property and sell those spaces? And the other one I would say is depending on your location, is signage. Whether, you put a sign that comes off the roof and you're advertising for someone, or you can find a way to take a little square footage on the ground and build a billboard that, is seen from the freeway or something else. That, those billboards are great returns on capital. So just look for things like that you can do to your property.
Awesome ideas there. Thanks, bud. Jason and I were talking about this one this morning, childcare assets. And that just as a great opportunity, we've got a couple reasons here. Many areas across the country are childcare deserts. There's just not enough childcare. Over 20,000 facilities have closed in recent years. Again, speaking to the demand, I would imagine that there's probably more kids in the United States today than probably any other time, just because of how population grows. Also, parents as a segment of the population have the highest level of employment of any segment of the population. So there's certainly a need. 78% of families eligible for childcare subsidies do not use them, often because there's no available space at a local facility or because they live in a place that doesn't have enough childcare. And then government subsidies, we're looking at ways that, how can the government help through a recession? One of them was to get more people back to work. And so government subsidies would get more people back to work and help level the gender pay gap. And those are two things: getting more people back to work, subsidizing childcare, and leveling the gender pay gap that, like opportunity zones, would garner broad political support and probably get passed. Jason, any additional comments you want to make on some childcare assets? We've got clients working on acquiring some of these right now.
I think that they're great. And I think to support, I think what is the third bullet point, currently we are at the highest percentage ever in the history of the United States of dual parents employed and working. So childcare is a much needed item right now. So, and a lot of actually employers are even considering giving it a subsidy as an employment benefit to parents as well, besides the government.
And in an environment where there's a labor shortage, probably a great incentive, and one that, again, helps maybe make these great assets to target as somebody transitions into a new asset class or looks to put money into something that'll do really well. Back on our last slide, we talked a lot about, let's call it government stuff, little or no rent control restriction, government that supports business and growth, areas with growing economies. We included some state income tax on the next 3 slides, but these are the states with no or the lowest income tax. Now, for those of you that reside in California, you're still going to have a bit of a tax issue as it relates to the state of California. But those of you that have moved your primary residence out of the state or are looking to do in the future, these are the states that have the lowest or no state income tax. Jason, are you seeing a number of your clients move equity into some of the states on this list?
Yes. I think the big ones are Texas, Nevada, Florida, a lot into Tennessee. Some of these states have great tax benefits, but not huge populations. And so Washington as well, just because of all the tech that's up there as well, although there's some concerns about being directly in Seattle. But those are some places where it's a really good opportunity. And even if you're not looking at moving now, it's worthwhile to potentially move your assets for future benefit.
We'll couple that with the most landlord-friendly states. Jason had mentioned it earlier regarding rent control. I believe there's 6 states in the District of Columbia that have some form of rent control. So that leaves 44 others out there with no rent control. I think I said in our last one of our last webinars, when we were talking about opportunity zones, or at least out of state, that when I was in Tennessee recently, meeting with management companies, some of the things that we see, whether it's split roll or rent control stuff, aren't even on the horizon in some of these other states. So, Jason, I'll ask you the question again. Your clients that are going out of state, are they predominantly targeting these states, or are there some other places that they're looking to?
I think this is a pretty accurate list. And you'll see the cap rate compression in some of these places because people see the opportunity or the safety relative to where the money's coming from. But this is a pretty solid list of where everybody's going.
Our third great places to target. We've got Buckhalter's fastest growing office at number 1 on this list.
Our second fastest growing office at number 2.
Yeah. Is there an office in Boise yet?
No, but our Seattle office is like top 4 fastest growing, I think. So that's number 4. But
so then what we decided to do is we decided to look at, all right, let's look at those 3 things and put them together in a Venn diagram, which we all remember from high school math, and looked at economic ranking, no income tax, and landlord friendly. We get a number of states that have 2 of those things. And then where we've seen probably the most California money move over the last couple of years as people have taken money out of California and redeployed it into other markets. Texas and Florida leading the way in all 3 of those and really being the best of the best. Jason, any comments when you look at it like this regarding, opportunities? And maybe a better question is, how satisfied are your clients that have gone to some of these places and moved their equity out of California?
So I haven't had a client that's been upset for leaving or moving their equity out. That's the first thing. I think Texas and Florida are great. Part of me prefers right now. So the primary markets in those states, the major metropolitan areas, anything in like Miami or Dallas, is really expensive. But if you go to, secondary cities, Houston, Orlando, tertiary cities, San Antonio, Tampa, that's where people are still seeing really great opportunities and returns. And I think those are some places that are worthwhile to look at. I'm also still a fan of Colorado. There's a lot of opportunities in Colorado, especially if you get outside of Denver. I know you love Colorado Springs. I will make a plug for Colorado Springs because we've had some clients do well there over the last 2 years. Arizona's a great market still, but we're starting to see, we've been seeing some deals, Justin, where the cap rate on an apartment building in the greater Phoenix area is within 25 basis points of like a deal in Santa Monica or prime Orange County, which at that point, I mean, yes, you're leaving for some benefits, no rent control, easier to increase rents, some safety as a landlord, but you're not getting a substantially larger return. Where I think if you go to certain places in, Texas, Florida, even Colorado, there's some real opportunities in places like that still.
Yeah, it's an interesting point that you make. Like there are still benefits, right? Like if you bought a deal in Scottsdale and it's 25 basis points higher than Santa Monica, that's below the historical, typical cap rates between the two. But it's also, we're comparing in some cases apples to oranges, right? Like 20 years ago, or maybe let's not use Santa Monica, let's use Newport Beach, or Costa Mesa. 20 years ago, that's a different environment as it relates to rent control, landlord restriction, just all kinds of stuff. Eviction or no fault evictions, things like that. It's a totally different environment. And so today, in places that don't have those sort of things, that also are seeing population growth when maybe places like LA aren't, we are in a different environment as it relates to maybe what that spread is between cap rates.
I also think to that end too, we're in a situation where in the past we would see certain markets, Miami, parts of Florida, parts of Arizona collapse when the economy went down. But I think we've had a major employment shift into those markets and therefore a major population shift. I think it's a more stable shift this time than it has been in the past, right? It's not, oh, economy's good, I'm going to have a second location or a second residence, or, I'm going to just spend some more time down there, or I'm moving to try it out. I think people have moved a lot with employment. And so I think the population movement is a stable situation versus a more volatile one that it's been historically.
We've got 4 minutes left, my friend. When we start, I'm always not sure we're going to fill an hour. And when we get to this point, I'm like, how are we going to get it all in? Let's talk about what's on this slide here and make some comments, because I think this is critically important for the other side of the coin. The people that I want no headache management, people that maybe have an asset that's not in the greatest area, but everything's been okay and everything's been good. That change is good, and now may be the time to do some stuff. No headache management, I don't think is going to work really well in office apartments or small industrial product right now. I think we all have to be concerned about split roll. For those of you that don't know what it is, reach out to us. We're happy to talk with you and explain it to you. In short, there's been a segment of the legislative body that wants to tap into more property taxes on really wealthy owners and successful people's real estate portfolios, and remove the Prop 13 protections. First, it started on commercial property. It's changed. Now, in its third attempt, they're going to go after all assets larger than $4 million, including single-family homes. And what that would do is that would change your property taxes based on the assessed value today. So some of you industrial owners that have owned a building for 30 years and paid $250,000 for it, and now it's worth $5 million, your property taxes are going to be based on that $5 million in 3 or 4 years. Key thing on it, it's the third time it's been on the ballot. A lot of things in California didn't pass until the third time it was on the ballot. Whoever wants to get it passed kind of figures out how they need to tweak it and change it to get enough support. And split roll is going to be back in 2022. I want to get to this last one in our last couple minutes. A couple strategies that Jason and I have talked about today, but also in a lot of our calls over the last year and a half on some really great strategies. Gritty to pretty, for those of you that don't know, if you have an older building, it's far away, it's not in the greatest area. We believe right now at Centennial, we can show you that you can make way more money over the next 10 years with a much better building in a much better area. There's still a window to do it. Reach out to us and talk about it. The prepay now to increase cash flow in the years ahead. Jason mentioned that a couple times. And then the bottom one on there, over the last 6 months, and Jason and I have done a bunch of webinars on it, opportunity zone investing of capital gains into pre-certificate of occupancy product is a phenomenal opportunity. The marketplace is not priced the opportunity in for a buyer into their pricing on what's being sold. You get a tremendous value. Jason mentioned it in passing earlier. but is something that we both think is a great opportunity and can explain in great detail. Jason, any other generally great strategies right now people should be doing before it's too late?
I think this is it. I think the plan is you should really sit down over the next week, sit down with an advisor, analyze your entire portfolio, and decide which direction you want to go. Two quick plugs I will say for the opportunity zones. One, we underwrote a deal the other day, Justin and I, with some bonus depreciation benefits. The value of the actual property in the long term could go down to zero, and the client could sell it for zero, and they would still end out net ahead from an investment standpoint with the tax benefits and everything else and depreciation and all of that. So that's something to keep in mind. There's an incredible amount of value there. The second thing I'd like everybody to keep in mind on those opportunity zones is during a market slowdown, it's never bad to be holding cash. When you sell a property, if you choose to sell one and go into an opportunity zone, you actually get to take whatever your remaining or basis is on the sale. So let's say you bought it for 5, you've depreciated it down to 3, it's now worth 10. You can take that 3 million and just put it in the bank tax free. It's not like an exchange. And then you have to invest that 7 into the opportunity fund. That 3 you can ultimately sit on, wait for the market slowdown to happen, and then take advantage of some really great opportunities by sitting on 3 million in cash at that point. So it's not a bad time to consider, maybe instead of an exchange out, sit on some extra cash, put the rest in the opportunity zone. We'll do what we can with some accelerated depreciation and cost seg to protect your tax bill in California this year. We can talk through all of that, but it's just something that's worth looking at long term. But really sit down now with your advisor and analyze your portfolio. That's the one thing I can say. And even if it's you're going to refi now, it's still worth just analyzing, is the refi the right situation?
Jason, that was a great closing comment. For everybody who attended today, we appreciate your attendance. We're going to do this again on April 28th. The game plan then is to give a legislative update on some of the things that we are seeing work its way through Sacramento. We'll also update everybody on interest rates and get to the 4 or 5 other ideas and strategies that we didn't get to today. As always, Jason, it's a pleasure to do this with you. Thank you so much for providing your insight to everybody at Centennial and all of our clients. And we look forward to talking to everybody the next time we do this. Thank you.
Thanks for having me.